Hey everyone, and welcome to our deep dive. This time all about portfolio allocation, balancing risk and return when you're investing across a bunch of different assets.
Exactly.
You said some fascinating research comparing traditional methods, like the Markowitz model,
Yeah.
to a new approach called deep reinforcement learning, or DRL for short.
Mm-hmm.
DRL basically allows computers to teach themselves how to be investors, and that's what we'll be unpacking today.
That's right. It's a really interesting field with a lot of potential to shake up the world of finance.
Absolutely.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Let's start with something familiar. For folks who maybe haven't encountered it before, the Markowitz model, it focuses on this balance between risk and return.
Yeah.
Can you walk us through some of the key ideas behind this approach?
Sure. So the Markowitz model was developed by economist Harry Markowitz, and what it does is it helps investors create what's called an efficient frontier. So essentially, this helps you find the portfolio with the highest expected return for a given level of risk, or vice versa.
So it's about finding that sweet spot where you're maximizing potential gains without exposing yourself to unnecessary losses.
Precisely. One of the core principles of the Markowitz model is diversification.
Right.
Spreading your investments across various asset classes like stocks, bonds, commodities.
Yeah, makes sense.
The idea being that different assets tend to move in different directions.
Mm-hmm.
So if one investment goes down, others might go up, and this helps to cushion the blow.
Right, kind of like that old saying, don't put all your eggs in one basket.
Exactly.
So then this new approach, this DRL, how does it actually differ from these more traditional methods?
Well, DRL takes a completely different approach. Instead of relying on predefined formulas or historical data, DRL leverages machine learning to allow computers to actually learn from their own experiences in the market.
Oh, wow. So instead of crunching numbers and analyzing historical trends, we're basically letting the computer loose in the market to figure things out on its own.
In a way, yes, you can think of it like training a dog. You reward it for good behavior, correct it for bad behavior, and eventually it learns to make the right decisions.
I like that analogy.
Yeah.
So we're essentially giving the computer a bunch of market data and letting it experiment until it finds the most profitable strategies.
Exactly. The algorithm will start by making random decisions, but through a process of trial and error, it learns which actions lead to higher returns and which ones lead to losses. And over time, it becomes better and better at navigating the market and optimizing its investment choices.
That's incredible. It's almost like we're creating a little AI investor.
Yeah, that's a great way to put it.
That can learn and adapt on its own.
Yeah, it's fascinating to think about. The computer isn't explicitly programmed with rules for investing. It learns those rules on its own through experience and adapts its strategy as the market conditions evolve.
Yeah, that's pretty incredible. It sounds like DRL could have a huge advantage over traditional methods, especially in today's market, which is changing so rapidly. But how do we actually know that it works? The research you shared puts DRL to the test, right?
It does. The research paper that you provided directly compares the performance of a DRL model to traditional portfolio management approaches using real-world market data.
Okay.
And they tested these models on a diverse set of assets, including stocks, bonds, commodities, and real estate.
So it's like a real-life investment competition.
Exactly.
DRL versus the classic strategy. What were the results of this matchup?
The results are actually quite compelling. The DRL model significantly outperformed the traditional methods across several key metrics.
Oh, wow. Can you give us some specifics? What kind of performance difference are we talking about?
Sure. The study found that the DRL portfolio achieved an average annual return that was 10% higher than the portfolio managed using the Markowitz model.
Wow.
Not only that, but the DRL portfolio also exhibited 15% lower volatility, meaning the investments experienced fewer and less dramatic price swings.
That's a substantial difference. Higher returns and lower volatility. It sounds almost too good to be true. Is there a catch?
Well, there are always caveats, right, when dealing with new technologies, especially in finance. While the results are very promising, it's important to remember that this is still a relatively young field of research.
Yeah.
More studies and real-world applications are needed to fully understand the long-term potential and also the limitations of DRL in portfolio management.
So we shouldn't necessarily rush to replace all of our financial advisors with algorithms just yet.
Exactly. While these results are very exciting, we need to approach this technology, I think, with a healthy dose of caution and critical thinking.
Yeah, one of the things that makes me a little bit hesitant is this idea of a black box. We don't fully understand how the DRL model is making its decisions.
Yeah.
It's sort of like trusting a chef who creates these amazing dishes but refuses to share their recipes.
That's a valid concern. The lack of transparency in how some DRL models operate is definitely a challenge. Researchers are actively working on developing methods to make these models more interpretable. But for now, we have to acknowledge that there's a degree of uncertainty involved.
I think it's also important to emphasize that while DRL shows great promise,
Yeah.
it's not a guaranteed path to riches.
Right.
The market is complex, it's constantly evolving, and no model, no matter how sophisticated, can perfectly predict the future.
Absolutely. DRL, like any investment strategy, involves risk.
Yeah.
It's crucial for investors to understand the technology, its limitations, and the potential risks involved before making any decisions.
This is all incredibly fascinating. Now, what does all of this mean for you, our listener? Why should you care about these advancements in AI and investing?
Well, for starters, this technology could have a significant impact on how your money is managed in the future. Imagine having access to AI-powered tools that can personalize your investments based on your specific risk tolerance, your financial goals, your time horizon.
It's like having a super intelligent financial advisor, available 24/7, constantly learning and adapting to market conditions to help you achieve your financial objectives.
Exactly. And while DRL is still in its early stages, it's evolving rapidly. Staying informed about these advancements can help you make more informed decisions about your investments and potentially benefit from the opportunities this technology presents.
This deep dive has certainly given us a lot to think about. We started with the familiar territory of the Markowitz model, exploring its core principles and how it helps investors balance risk and return.
Then we delved into the world of deep reinforcement learning, where AI systems learn to navigate the complexities of the market through trial and error, constantly refining their strategies to achieve optimal results.
We also discussed that groundbreaking research that showed DRL outperforming traditional methods by a significant margin, achieving higher returns and lower volatility.
And while this technology holds immense potential, we also emphasize the importance of caution, transparency, and a clear understanding of the associated risks.
Absolutely. As we wrap up this deep dive, we want to leave you with one final thought-provoking question to ponder. So as DRL continues to evolve, how might it change the way you think about and approach investing? Will you embrace this potential of AI-driven decision-making or stick with those more traditional methods? There's no right or wrong answer.
Right.
But understanding these emerging technologies, I think, is really essential for navigating the future of finance.
Yeah, it's an exciting time to be an investor. We're witnessing this convergence of finance and technology in ways that were unimaginable just a few years ago. And DRL is just one example of how AI is really transforming the investment landscape.
This deep dive has been a fantastic exploration of both the familiar and the cutting edge in portfolio management. We've kind of demystified some of those traditional approaches and provided a glimpse into the exciting potential of DRL.
Yeah, it's been a pleasure joining you on this journey of discovery.
It's been great having you, and remember, the world of finance is constantly evolving, so stay curious, keep exploring, and as always, happy investing.